Let me be straight with you. Most people are one bad month away from financial stress, not because they don't work hard, but because they only have one source of income. Today, I'm going to change that. I'm walking you through 6 passive income ideas that actually work for busy professionals. People who don't have all day to babysit their money, but still want it growing in the background. I've been in the corporate grind for over a decade, and I'll tell you this honestly. My salary alone didn't build the life I have today. Passive income did. And if I could build it while working full-time and managing everything else life throws at you, so can you. Now, I'm not just going to throw a list at you. I'm going to rank each of these 6 ideas across 3 things that actually matter. Upfront cost, how much you need to get started. Earning potential, the realistic long-term payoff. And simplicity, how hands-off it truly is, because passive should actually mean passive. Let's get into it. The first idea is startup investing. And no, this isn't just for rich venture capitalists anymore. Thanks to equity crowdfunding platforms, everyday people can now buy into early-stage companies before they go big. Here's how it works. In the US, platforms like StartEngine, WeFunder, and Fundable let you buy equity in private startups, sometimes for as little as $100. Over in the UK and Europe, Crowdcube offers a similar experience, with some entry points as low as €10. You're essentially becoming a part owner of a company you believe in. If that company grows, gets acquired, or goes public, your investment can multiply significantly. And along the way, many platforms offer community perks like product discounts, early access, or investor-only benefits. Some platforms, like StartEngine, even allow you to resell your shares on a secondary marketplace. Now, I have to be honest with you here. This is high risk, high reward. Startups fail at a high rate. So if you jump into this one, please do your homework. Read the funding proposals carefully. Understand the business model. And never put in money you can't afford to lose entirely. A smart approach is portfolio diversification. Spread small amounts across several startups instead of betting everything on one. If even one of them takes off, it can justify the whole portfolio. One more thing worth knowing. Most startups don't pay dividends. They reinvest profits to fuel growth. So your return only comes if and when the company sells or goes public. It's a long game. Rating-wise, low upfront cost since many offerings start around $100 to $500, which earns it a solid score. Profit potential gets a 3 out of 5 because while the ceiling is high, the risk of losing everything is real. And simplicity scores well. Once you've done your research and invested, there's nothing left to manage. If startup investing feels a little too risky for your taste, the second idea is one of the safest things you can do with your money right now, a high-yield savings account. Think of it as your regular bank account, but actually working for you. Instead of earning near zero interest like a traditional checking account, a high-yield savings account can currently offer around 4 to 5% APY. That number might shift over time, but the core concept stays the same. Your money sits there, earns interest, and you do absolutely nothing. Personally, I run 2 of these accounts. The first holds my emergency fund, money I don't plan to touch, but can access instantly if life throws a curveball. The second functions like a checking account. I get paid into it, pay my bills from it, and any balance sitting there earns interest automatically. It's a simple swap that makes a real difference compared to leaving money in a standard account earning almost nothing. When choosing a platform, the 2 things you should always check are, first, is it FDIC insured? That guarantees the first $250,000 of your deposit is protected if the bank collapses. Second, does it allow quick, unlimited transfers? If you're using it as a checking account replacement, you need that flexibility. My ratings for this one. Upfront cost is almost zero. Many top online banks have no minimum to open. Growth potential is moderate and steady, not explosive, but reliable. And simplicity. This is the most passive thing on this entire list. Open an account, deposit your money, and walk away. You're done. Before we go further, if this kind of content is useful to you, hit like and subscribe. I cover money, careers, and personal growth regularly, and I don't want you to miss what's coming next. Alright, idea number 3 is one most people completely overlook: buying a local business or franchise. Here's the mindset shift you need. Wealth isn't exclusive to Silicon Valley. You don't need a groundbreaking app or a tech startup to build serious income. Boring, reliable, essential service businesses have been making people wealthy for generations. The strategy is straightforward. You buy a proven, profitable business, hire the right people to operate it, and collect the profits while they handle the day-to-day. There's a compelling case that buying small businesses is one of the fastest and most overlooked paths to wealth. Many of these businesses are owned by people approaching retirement who are actively looking for a buyer. They come with an existing customer base, a track record of revenue, and processes already in place. You don't have to build anything from scratch. You're stepping into something that already works. The types of businesses to look for are what I call recession-resistant essentials: laundromats, car washes, HVAC companies, cleaning services, pest control. These aren't glamorous, but people always need them. Rain or shine, boom or bust, the demand is there. But I don't have the cash to buy a business, you might be thinking. Here's the thing, you don't always need to. Seller financing lets you negotiate with the owner to fund part of the deal themselves. SBA loans offer government-backed, low-interest financing. You can bring in equity partners, use the business's own cash flow to finance the purchase, or even structure deals around future profits. When evaluating any business, focus on 3 things: strong cash flow with simple operations, consistent and positive EBITDA, and recurring revenue with loyal repeat customers. Avoid anything that requires the owner to be present constantly or has unpredictable income patterns. Marketplaces like BizBuySell, BizQuest, and Flippa are good places to start browsing listings. Ratings: upfront cost gets a 4. It varies widely, but creative financing makes it far more accessible than people think. Earning potential is high. A well-run business with a good management team can generate serious passive income. Simplicity takes a bit more work upfront, but once you have the right team in place, it's largely hands-off. Moving into the investing world now, idea number 4 is dividend-focused index funds, and this one is a personal favorite of mine. Here's the concept in plain English. Some companies, big, established brands like Pepsi, McDonald's, Starbucks, share a portion of their profits with shareholders on a regular basis. Those payments are called dividends. A dividend-focused index fund pools together a large group of these dividend-paying companies so you get exposure to all of them at once, without having to pick individual stocks. The beauty of this strategy is consistent cash flow without ever having to sell your investments. Your shares sit there, companies pay you a portion of their profits quarterly, and you either spend that money or reinvest it for compounding growth. When choosing a fund, here's what to focus on. First, look for dividend growth funds, ones that invest in companies with a history of increasing dividends year over year. They might yield slightly less today, but your income grows over time. SCHD and VIG are 2 well-regarded examples in this category. Second, always check the expense ratio, ideally below 0.1%. Every fraction of a percent in fees is money leaving your pocket. Third, consider adding an international dividend fund like VYMI for broader geographic diversification. Most dividend funds yield somewhere between 2 and 4% annually. Over a 10-year period, total returns including price appreciation often land around 10 to 12% annualized for the stronger funds. After dividends are paid, you have a choice: reinvest automatically for long-term compounding, or take the cash if you need regular income. Both are valid depending on your stage of life. Ratings: starting investment is flexible. Even $100 gets you in the door. Long-term returns are solid. Setup takes about 20 minutes to open a brokerage account and buy your first fund. After that, mostly just let time do the work. Idea number 5 is REITs, or real estate investment trusts, real estate income without a single landlord headache. A REIT is essentially a company that owns and operates income-generating real estate, apartments, shopping centers, warehouses, hospitals, office buildings. By investing in a REIT, you're buying a slice of that entire real estate portfolio without ever touching a lease agreement or fielding a 2 a.m. call about a broken pipe. Here's why REITs are particularly appealing for passive income. By law in the US, REITs are required to distribute at least 90% of their taxable income to shareholders. That creates a dividend yield that typically runs between 3 and 6%, higher than most standard dividend stocks. They also trade on public stock exchanges like regular stocks, which means you can buy or sell your position anytime, giving you a level of liquidity that physical real estate simply can't match. You can invest in individual REITs across specific sectors, healthcare, residential, industrial, retail, or simplify things by buying a REIT ETF, which bundles many REITs together instantly. Fair warning though, REITs are sensitive to interest rate changes and economic conditions. Retail REITs, for example, took a serious hit during COVID lockdowns. That's why a buy and hold mindset works far better here than trying to trade in and out. Think of it as collecting ongoing rental income from a portfolio of properties you never have to manage. Ratings: very accessible with starting investments as low as $10. Growth potential is good with reliable dividends. And ease of management? Just buy and hold. It doesn't get much simpler than that. The sixth and final idea is perfect if you want to invest but genuinely have no idea where to start: robo-advisors. A robo-advisor is a digital platform that manages your investment portfolio completely automatically. You answer a short questionnaire about your financial goals, timeline, and risk tolerance. Maybe 10 minutes of your time, and the platform takes it from there. It selects a diversified mix of low-cost ETFs covering stocks, bonds, and sometimes REITs, allocates your money accordingly, and automatically rebalances your portfolio when things drift off target. What makes robo-advisors stand out is what they remove from the equation: the guesswork, the emotion, the decision fatigue. You're not picking stocks. You're not watching charts. You're not second-guessing every market headline. The algorithm handles all of it. Fees are also very reasonable. Most robo-advisors charge between 0.25 and 0.5% annually, a fraction of what a human financial advisor would charge for similar work. Many also offer tax loss harvesting, which automatically sells losing positions to offset gains and lower your tax bill. It's a feature that sounds complicated but happens entirely in the background. Popular platforms in this space include Betterment, Wealthfront, and Schwab Intelligent Portfolios, among others. Long-term annualized returns from a robo-advisor portfolio typically fall between 6 and 10%, depending on how aggressively you're invested. That's in line with a broadly diversified stock and bond mix. Nothing flashy, but highly consistent over time. Ratings: starting investment is very accessible. Most platforms accept anywhere from $10 to $500 to get going. Return potential is solid and realistic. And simplicity is about as high as it gets. Set it once and let the algorithm do the work indefinitely. So there you have it, 6 legitimate passive income streams, each with a different risk profile, investment requirement, and level of involvement. Whether you're just looking to squeeze more out of money that's already sitting in a bank account, or you're ready to buy a business or build a dividend portfolio, there's something on this list that fits where you are right now. The most important step is always the first one. Pick one, start small, and build from there. Passive income isn't built overnight, but once it's moving, it doesn't stop. One final note: everything I've shared here is for educational purposes only. This is not financial advice. Please do your own research and speak with a qualified financial professional before making any investment decisions. If this video added value to your day, I'd really appreciate a like and a subscribe. It helps more than you know. And if you want to go deeper on any of these strategies, I've got another video lined up that you're going to want to see. I'll see you there.